So you've built equity in your home and maybe the value shot up in the last few years and you're wondering, how can I put the equity to work without touching my low mortgage rate? Well, today I'm breaking down everything you need to know about a HELOC or a home equity line of credit. What it is, how to apply, the smart ways to use it for investments, what to avoid, and the risk you've got to watch out for. If you stay until the end, you'll walk away with a clear step-by-step plan and my personal rules for using a HELOC without putting your home at risk or your credit at risk. But before we dive in, what if you could turn a line of credit into $50,000 cash in just 12 months? One of our students, Will, he did exactly that. And Russell, he went from 0 to $74,000 in 14 months. And then there's Coach TJ, he went from 0 to $103,000 in 18 months. And oh yeah, there's Altis. He pulled off a whopping $18,000 in just 120 days. The crazy part is, they all started in the same place you are in now. Want to see how they did it and how you can do it too? Join our free community. The link is in the description. Book your free call. If you're a fit, we'll personally walk you step by step to your first $15,000 in 120 days or your money back guaranteed. For those of you who don't know, a HELOC, a home equity line of credit, is a revolving line of credit secured by your home. So basically, it's a secured line of credit. It's like a credit card, but with a lower rate and a much larger borrowing capacity. Here's how to figure out what you might qualify for. For example, let's say you have a home or your home is worth $400,000. That's the home value. And you have a mortgage balance of about $250,000. That's what you owe your current mortgage. And that equity spread, so you've created over the years $150,000 worth of equity that's technically sitting in the property as of today. If your lender offers 80% loan to value, check out this calculation. 80% of $400,000 is $320,000. $320,000 minus $250,000 leaves you with $70,000 left. So that means you can get a HELOC or home equity line of credit up to $70,000. Now get this, you only pay interest on what you borrow, not the whole line. So if you have $70,000 available and you only use $20,000, you're only paying interest on $20,000. Because a HELOC is secured by your property, the lender will record a second lien, meaning if you don't pay, they can foreclose. That's why this is a tool for the disciplined investor, not impulse spenders. I do not recommend this for people who are undisciplined. What it will look like is that you keep your current mortgage in place, right? So you continue with your current mortgage, you continue with your current monthly mortgage payments. Then you will have a HELOC, which is the second lien on the property, which is a separate loan. Generally with another bank, if you use 0 of the line, then you pay nothing that month. But if you use $20,000 that month, then you will have to pay interest only on the $20,000 the following month. So, or until you pay off the $20,000 back, which that becomes available again for use. And of course, the more you use, the higher the monthly interest payment will be. So yes, you can at any given point in time have 2 payments. You will have your monthly, your normal regular monthly payment. And if you use the line of credit, whatever you used, they will charge you interest on that used portion. And so therefore you will have another monthly payment or another monthly obligation that you would have to make that is tied to the property. Hey, if you like the content that Elridge dropping, if you like the content I'm dropping, hit the like button, subscribe and share. It helps to get the word out to others so that YouTube can continue to spread our content. Applying for a HELOC isn't complicated, but doing it the right way can save you thousands, and also it can minimize a lot of headaches and stress as well. Step number 1, search for local credit unions or regional banks. Skip the national chains like Bank of America, your Chases, your Capital Ones, and your Wells Fargo. Apply to 3 different lenders so you can compare terms. This is very important, guys. And to learn more on how to choose low-risk loans, go ahead and join our free community. Yes, we have a class on that too, and it's 100% free. Step number 3, gather proof of your income. Yes, they're gonna ask you for bank statements, they're gonna ask you for your tax returns, so be prepared to be able to show those. Your latest mortgage statement, they wanna know that you are current. And that's another thing. If you've made any late payments on your mortgage within the last, 3 years or the last 12 months, you definitely need to check with the bank to see what their terms are. But if you made a late payment or skipped a couple of payments, or you're not in good standing with your current mortgage company, the likelihood of you being approved may not necessarily be high. It is closer to probably being denied. And also be ready for an appraisal. So why do we want local lenders? That's a really good question, but kind of self-explanatory. It's because they often have better rates, they are lower fees, and they are more flexible because they know your local market. So that's why we recommend that you choose a local credit union, or you choose a smaller bank or regional bank. And here's a pro tip. By applying with multiple lenders, you can choose the one that gives your home the highest appraised value, which directly impacts how much you can borrow. So banks may offer a drive-by appraisal. I did this one. Now they are going to ask you, have you done any recent repairs or upgrades in the last 12, maybe 36 months? They're going to ask you for those values of each of those particular line items. Now, be honest. This is to benefit you. Do not lie, because if you lie, then you're actually shortchanging yourself. Or versus if you're telling the truth about any upgrades that you did, then you're potentially boosting again the value of your home. So if you've got a brand new toilet last month, then say that or list it. If you put a new roof on in the last year, then list it. That's also valuable. If you changed out the carpet to laminate, then list it. Some lenders will ask for a full appraisal, meaning they're going to come into the home, they're going to measure the home, they're going to take interior and exterior photos, and they're going to do a full-blown comparable analysis of your home to homes that are like, kind, and quality regarding finishes, exterior finishes, interior finishes, and the size of the home, of course. If this is the case, then put your best foot forward. You know what I'm talking about when I say put your best foot forward, right? That means declutter and do a deep clean. Any broken cabinets, repair or replace them. Concentrate on things of value. So an award-winning garden might not be the best thing to concentrate on, because it may not give you as much value as it is if you were to replace or repair a vanity in a countertop. Let's discuss some key terms. One term is loan-to-value, or LTV. This is the percentage of your home's value the lender will lend on. Most are going to lend anywhere from 75 to 80%. Some will go as high as 90 to 95%. Now, I gave an example using the formula on this in the video earlier. So press the back button if you need to review how to calculate the LTV. The more they give, the more it will cost you in interest, but you have complete control over the cost. I hope I didn't confuse you. Remember, you only pay for what you use, and by keeping your daily balance low, you keep the effective interest rate low. This is another term you need to be familiar with. Interest rate margin. This is your rate equals prime rate plus the margin. So here it is. Say for instance, the prime rate is 8.5%. And the margin is basically what the bank is charging, which is their point, right? It would be 1%. So the rate, or the total rate, is going to be 9.5%. Yes, this is an adjustable rate. So if the prime rate goes down, so the bank rate will never change. But if the prime rate goes down, so does your monthly charge. But this isn't singular in nature, meaning you still have some control. It's not like an amortized loan. On a HELOC, you have more control than you think to keep the charges low. For more information on this, join our free community. Another term you need to be familiar with is called the draw period. usually between 5 to 10 years, and it's interest-only payments. Then there's the repayment period. So this is principal plus the interest for 10 to 20 years until the balance is paid off. Now listen, generally after the draw period, or basically the original line of credit term, which is usually credit unions will do 5 years. Some of your local and regional banks will typically do the 10 years. There are some people that will actually do a little bit more than 10, but 10 is generally the average, right? So what happens at the end of that line of credit period, when it becomes close to its maturity date, the bank will give you a call. The conversation will go something like this. Hey, Mr. Borrower, we are about a month out before this line of credit ends. Would you like to reapply? So at this particular point, you have a choice. You can reapply for the line of credit. This is why it's important to keep your credit clean throughout these next 5 or 10 years. So therefore you can reapply to keep this as a line of credit, or they'll give you an option to turn what you owe. So that would be your principal plus your interest into a regular term loan or a permanent loan, right? And so you don't want this. You don't want to turn it into a permanent loan. You want to be able to reapply, so therefore you can keep your line of credit. And everything continues as before, but with a fresh set of years. So here's a pro tip. Ask the lenders about any introductory offers that they may have. A lot of times they are running these offers when you apply for home equity lines of credit. Sometimes opening a checking account in their bank or setting up a direct deposit can lower your margin by 0.25% or by 0.50%. Yes, they have some great introductory offers. Some will offer no out-of-pocket cost to you to close the loan. They may pay for the appraisal, or in my case, don't quote me on it, but if my memory serves me correctly, I think I had like some type of discounted interest rate, which I think I mentioned that earlier, for like the first 6 months or maybe the first year, something like that. So they do make those offers to you, and make sure you're aware of those offers. That's also something you might want to consider when you're choosing the lender who's going to service your HELOC. Now let's talk about the use. This should go without saying. For those of you who fall into temptation every now and then, do not use this for vacations. Don't go on a shopping spree. Don't go restaurant crawling. Don't use it for down payment for cars, personal expenses, long-term investments. If you can't get your principal back in 18 months or less, then don't use a HELOC for anything, or any other line of credit, for as a matter of fact. Remember, this HELOC is secured by your home, so don't be reckless. If you misuse it, your home is on the line. Here's our rule of thumb. If it's not a cash flow short-term asset, or you have no clue how long it will be before you get your principal back, then aggressively turn around and run in turbo mode. Just don't do it. Oh, and do not give out a loan using your HELOC to a family member or friend. Find another way to help them. And yes, I'm in your business. On a basic level, most people use their line of credit for fix and flips, or they might do the BRRRR method, which is buy, rehab, rent, refinance, and repeat. And then they'll take out, when they refinance, then they'll pay off their home equity line of credit with the refinance proceeds. And then they might do any type of short-term funding where they might fund small projects for other investors. So AKA, it's called lending. But the absolute best use is what we teach. Take the line and put it into an income source that maintains liquidity. It also should maintain cash value. It should earn interest and produce a monthly income. And you should have the ability to borrow against it without losing any cash value. And no, it's not an insurance policy. Then you use velocity banking to pay off the line of credit and buy the same income source again. Now set all this on autopilot and allow it to repeat the process over and over again. To learn how we'll use this to process to bank $50,000 in cash in 12 months using a line of credit, check out our YouTube video, how he made $50,000 using Velocity Banking. If you are in debt, use it to pay off your debt. We have free courses on this in our free community. What are the risks to a HELOC? Now, one of our students, Portia, she asked this question, which is a really great or really excellent question. So one of the risks is rate increases. Your payment could change from month to month. I think we discussed this already. Remember, the rate is whatever the prime rate is plus the bank's points, right? So it might be prime rate plus 1 or prime rate plus 2. If that prime rate changes, then of course your monthly payment changes. But again, you have some control to the cost by keeping the balance low. Then the lender can call it back. So in the downturn, like in 2008, I wasn't a part of this, I didn't have a HELOC then, but lenders can freeze the HELOCs and demand repayment. And they're not gonna ask you all the payment up front. It's gonna probably freeze it and turn it into a permanent loan. Then there's the risk of foreclosure. Of course, if you're defaulting and you can't afford what you used, and you potentially are risking your home to foreclosure. Then there's over leveraging. Using too much. Guys, don't over leverage. Don't use more than what you are able to handle or whatever the assets can able to handle. This also affects your credit score as well. Another risk is your current mortgage payment probably will increase. Here's why. Generally, when the HELOC is added, the lender will also ask you to increase your property insurance to include their loan. So you're gonna have coverage, enough coverage for your current mortgage and enough coverage for your HELOC. So now you are increasing your property insurance yearly premiums. And if this is escrowed into your monthly payment, this will cause your monthly payment to go up as well. So I just want you to be aware of this. A lot of the YouTubers miss this step. I don't know why, maybe because they never had a HELOC, I guess, or maybe not all lenders ask for this, but I'm a lender, and having my money insured is like lender basics 101. Here are 4 golden rules to using your HELOC in a responsible way. Keep it short term. Never carry a balance longer than 12 to 18 months. Again, if you're going to invest in something, make sure you can get out of that something at the shortest period of time possible. Anything over 18 months becomes absolutely dangerous for your line of credit or your home equity line of credit in this particular case. Having clear and objective exit strategy. Know exactly how and when you will pay it back before you even borrow the money. Never risk what you can't replace. Only borrow amounts you could repay from other assets or other income coming in. And number 4, never use more than 50% of the line of credit at any given point in time. If you use more, this will negatively impact your credit. A HELOC can be one of the most powerful tools in your wealth building toolbox, but only if you use it strategically, wisely, and don't be reckless. We use it to pay off debt, and we also use it to build wealth. If you're ready to explore this for your own investing journey, join our free community. See you on the next video, guys.